Good afternoon, everyone. We have 4:30 on the nose, so we're going to go ahead and get things started. So we are happy you're able to join us today for our third quarter market outlook. For purposes of this webinar, just so everyone knows, we have all the lines on mute and all your videos are turned off. So this is purely a view-only presentation today. Also, if you have any questions throughout the presentation, feel free to send us an email or contact us during our business hours. As many of you know, my name is Dane Williams. I'm a financial advisor here at Howe Financial Services. I'm also joined by Tyler Thompson. He also a financial advisor with our firm, and we are excited to provide you insights on several topics, including the pandemic, China trade relations, and of course, the upcoming election. For now, I'm going to turn things over to Tyler. He's going to introduce our speaker. Tyler, you got the floor.
Hello, everyone. As Dane mentioned, my name is Tyler Thompson, and I am also a financial advisor with Howe Financial Services. Tonight, we are very lucky to be joined by Mark DiSipio with BlackRock. For those of you who do not know, BlackRock is one of the world's leading providers of investment, advisory, and risk management solutions. BlackRock is one of the many companies we lean on to provide suitable investment solutions for our clients. Mark DiSipio is an iShares leader covering independent broker-dealers in the Heartland region. I truly hope that you enjoyed tonight's presentation. And with that being said, I'll now turn it over to Mark DiSipio. Thank you.
All right, great. Thank you, Tyler. Just to verify real quick, can you hear me all right?
I can.
Okay, perfect. Well, we'll get things started. Good evening, everyone. Thank you very much for joining us. Thank you for taking time out of your busy week to do so. I'm very excited to connect with all of you today. I will say as a caveat, please excuse the background here. I don't think many of you would think a global topic and investment management conversation would take place from a home office, but 7 months in now, this has been my home office, has been my working office, as has been the case for many people here. So appreciate you bearing with me on that and hope you enjoy our presentation here today. I'm going to go ahead and pull up our presentation and we will get started. All right, perfect. Excellent. So as we said before, we appreciate everyone joining us here today. As coming from my home office here, these certainly have been strange times over the last 7 months, also have been very harrowing and challenging times as well. The health and economic crisis is still ongoing, and my thoughts are with you, your families, and community today. I know there's a lot going on in the world. In terms of the markets, the last few months have been some of the most volatile in history. I'll do my best to help you make sense of what's happening and what we at BlackRock are looking out for in the near future. And there's no shortage of things to talk about. And ultimately, as challenging as this may be, the bottom line message here is that we hope you'll think long-term. In times of crisis, it can be really difficult to do this. I certainly understand that. No one is immune to fear, anxiety, or uncertainty, but it's times like this where it's perhaps most critical to think long-term. Our topics today and our time today will cover some of our views from BlackRock's Investment Institute, also known as BII. BII conducts economic and market research, develops investment views for our clients, and works closely with many of BlackRock's portfolio managers to help inform investment decisions around the world. So these are not just my opinions. They're not just an opinion from someone at BlackRock, as much as I think they may be important. BII holds a global daily meeting that gathers portfolio managers from all over the firm, and their views represent a collective perspective. Effectively, we're going to be talking about what does BlackRock think. So let's start with the bottom line. We view the coronavirus shock as a large-scale natural disaster that severely disrupts things now, but will eventually recover and result in an economic recovery. BII actually wrote the first line that you see in front of you here in April, near the bottom of the market. I can't stress enough myself that this is a view on financial markets and not on the health crisis that we have in our nation and across the globe. The scale of the health crisis is massive. We're just trying to take this from a financial lens. In terms of markets, we actually think that this crisis is different from 2008, as the economic and financial backdrop is much stronger today than it was back then. The key difference is that the 2008 crisis emanated from the economy, the financial sector, and the banks themselves, which led to a multi-year period of deleveraging businesses. We saw research and development slashed at most firms. We saw employees being laid off, plants closing. It was a very difficult time from that perspective in those sectors. So while the shock today has been far more severe and acute as we saw at the beginning of the year, we actually believe that we're on stronger footing than we were back then. The recent rebound that we've seen over the summer is proof of this. But the thing to keep in mind with this is that the more prolonged the health crisis continues, the greater the likelihood that cracks appear, exposing hidden financial vulnerabilities that could lead to more permanent damage. For now, we believe that the bold and revolutionary policy response has limited these risks so far. So before we get into the main themes that we're watching today, it helps to talk about where we are and where we stand. So where are we? We have had a historic drop in markets back in March, followed by an almost equally historical rise. Many are saying that this may have been the quickest bear market that we've seen in market history. The second quarter of 2020 was the 9th best quarter for US stocks in history. And as of the end of August, we've reached new market highs. The orange line that you see, or the red line that you see in front of you, shows the performance of the S&P 500 index. But as good as that sounds, jobless claims represented by the yellow bars here continue to reach historic levels, with millions unemployed and many businesses nowhere near pre-COVID levels. So the most common question I've received in the last couple of months is, aren't markets overextended? Or I've also heard, how can the markets be doing so well when the economy is struggling as much as it is? And the first thing I would say to that is you have to remember that the market is forward-looking. So while the graph you see seems to show a disconnect, it actually can help explain the rebound. Investors are looking to a positive trend in the numbers, anticipating that the worst may actually be over. Second of all, and I think this is important, it's important to distinguish that what we actually mean by market. We often use the S&P 500, as you see here, as a proxy for markets because US investors likely have had exposure to parts or all of this in their investments. But keep in mind that this in reality represents the 500 largest companies in the US. In fact, I just saw yesterday that the top 5 companies in the S&P 500 by market cap have obtained a 55% return year to date this year. So we see the strong leading the strong. And even within those 500 companies in the S&P, there have been outsized winners like Amazon and Microsoft and outsized losers like cruise lines. So taken in aggregate, we've seen a rebound. But at the end of the day, not all are created equal. So what does the road ahead look like? We're actually watching 4 key areas, and we've kind of deemed these the 4 horsemen for the second half of the year as key risks investors are watching. First is the path of the coronavirus itself. That's the visibility on the ultimate scale of the coronavirus outbreak and evidence that the infection rate has peaked. The second is US-China trade tensions, a trend that we've been watching closely before the crisis and may again begin to be a driver of markets going forward. The third, of course, is the US election and its implications on the ability to deliver a strong policy response. And the fourth is actually the policy response itself, the continued deployment of credible and coordinated policy packages and the impact on the markets. So let's dive into a little bit into each of these. First, the path of the virus is both the most uncertain and the most important factor in the market recovery. When portfolio managers at BlackRock were surveyed which factor was the most important when thinking about risk, the majority answered dynamics around the virus itself. And that's as opposed to thinking about macro growth, policy valuations, other economic factors. Investors seem to agree with this, with market volatility also often resting on the curve of the virus. or potential treatments. We see days that swing up and down with responses of potential virus vaccinations, outbreaks, increases in numbers. That seems to be the major driver. The challenge then is that the near-term outlook on markets is as uncertain as the near-term outlook of the health crisis itself. But it appears that while the death toll has been terrible and devastating, stringent shutdown measures initially helped stem the spread of the disease. And as we mentioned, the longer it takes for activity to normalize, the deeper the economic scars will be. So how do we begin to gauge whether the slow crawl to normal has begun? Well, one thing that we found was that initially, investors may have actually relied too heavily on government mandates as indicators. We actually at BlackRock believe that tracking mobility, shoppers, commuters, movement to the workplace, using big data to determine this may be the key to tracking the virus shock. Metrics that gauge the movement of people using mobile phone location data can help capture individual behaviors. These are more closely tied to economic activity than the severity of lockdowns our analysis has shown. So this means that the response of people to the virus has more impact on markets than government policy alone. But the pace of the activity restart depends on how successful countries are in suppressing the virus as they reopen. Our mobility research suggests that risks of a renewed virus outbreak may be the highest in the US among developed nations. We are seeing a gradual decrease in cases in aggregate, but a broader spike in cases may have a negative impact on the markets going forward. Secondly, the pandemic's added fuel to the geopolitical dynamic already underway. The post-coronavirus world is likely to be characterized by a bifurcated world with the US and China on opposite poles. In recent months, we've seen some very significant developments in the US-China relationship. We've seen it all in the news, the proposed bans on TikTok, the controversies of data sharing. There's a lot that's taking place right now. And these tensions will be a source of risks in the months and years to come. The graph here shows the tremendous ground that China has covered over the past few decades and the potential share of global GDP that they can take in the future. The intense rivalry looks to affect nearly every dimension of the US-China relationship, regardless of the US election outcome. Decoupling is focused on, but not limited to, the technology sector. The pandemic has also accelerated deglobalization as it magnifies nationalist and protectionist trends. We've been seeing this more and more. This threatens to disrupt the web of global supply chains at the expense of efficiency. So it may lead to onshoring the production of strategic goods. We also believe that there's an emerging bipartisan consensus that the US posture towards China needs to be pretty fundamentally rethought and put on more competitive footing. So while Trump and Biden may have different emphasis and use different toolkits, we believe we're likely to see this tougher posture and greater competitiveness regardless of who wins in November. So now to the much heralded election focus here. The US election is another risk that we're watching closely leading up to November. There are really three political scenarios: a Democratic sweep, Biden winning the House, but with divided control of Congress, or President Trump winning re-election with a Republican Senate and Democratic House. Some investors are concerned that a Democratic sweep would be a negative for markets, as the Democratic platform has proposed increasing corporate and individual taxes, which may hurt corporate earnings. While a divided scenario has generally been viewed as favorable, as taxes are less likely to change due to gridlock. The other thing to consider, though, is the first and third scenarios may be more beneficial to markets in the short term, as ongoing fiscal support is vital to keeping the economy afloat. In each of those scenarios, policy measures would have a smoother ride towards enactment. Many investors are getting concerned closer to the election, trying to guess which candidate or party may be better for markets. But our view is investors should take the long-term view. The next few slides are actually taken from our popular Student of the Markets piece, showing historical performance around presidential elections. As you can see, the main message is clear. Stocks have risen regardless of which political party is in power and have stayed remarkably resilient over time. Unfortunately, investors in presidential years tend to move money to money market funds or cash-like investments, and especially this year. While we've seen going back to 1993 an annual flow of $114 billion into money funds during a presidential year, this year we've seen $980 billion move to cash-like investments. We already know that investors that move to cash during market turmoil miss out on the market rally from this summer. And we believe that those who are acting out of fear with regard to the election may be making a similar mistake. Even when you look at one-year performance across election years, as you can see here, stocks have actually outperformed on average. The bottom line is that while every election cycle brings anxiety, new fears, and uncertainty, it's about time in the markets, and it's not about timing the markets. Last thing we'll mention here that we're monitoring is the wild card in the room, and that's been policy response. The government response so far has been nothing short of revolutionary. In the US, both sides of the aisle may be jaded at times with the political process, but in the face of this crisis on bipartisan basis, Congress has stepped up with an economic relief package that is unprecedented in American history in terms of its support for individuals who are out of work, small businesses, and larger businesses that may have been harmed by the crisis. This is really, truly an extraordinary thing. I think it actually calls to mind a wartime mindset more than a run-of-the-mill recession or even a global financial crisis mindset. And so that degree of do whatever it takes from policymakers offers some hope that we're going to be able to get through this chasm and come out on the other side with an economy that begins to accelerate again soon. The chart here shows what the Fed's balance sheet could look like by the end of 2020 compared with March 4th, just before it begins its interventions. As you can see here, the head of the BlackRock Investment Institute calls this response a policy revolution. And this graph shows the sheer scale of the commitment to stemming the impact to businesses and the economy from central governments. These graphs show the magnitude of the shock on GDP across 4 major regions. Effectively, the bars in red or orange reflect the negative hit on the economy, whereas the yellow bars represent the potential offset impact of fiscal policy on GDP. So as you can see, the sheer amount of stimulus may be why we are not yet seeing an unraveling of our financial system. People are receiving unemployment benefits, and that leads them to be able to pay their mortgage, keeps the economy rolling. But the risk now is that we're seeing a bit of what people are calling a policy fatigue, particularly in the US, as policymakers face a series of fiscal cliffs. That's why with regard to the election, regardless of who is in power, the ability to swiftly enact fiscal relief will be paramount. It's more about the response than it is about which political party is in power. So while we're hoping for a better future and believe that will be the case, the reality is that the near term does remain uncertain and likely to remain volatile until the path to defeat of the virus becomes clear. It's unclear how the pandemic will change societal preferences, how different industries and sectors will adapt, what companies will take the lead in digitalization in a more distanced world, and where global supply chains will relocate to. So I want to reiterate what I mentioned at the beginning of this presentation. We really believe that we may continue to receive harrowing and concerning information, but keeping a clear mindset and a long-term view is very important. So I'm going to share, to wrap up the last couple of slides here, a few long-term concepts that can really help investors take a measured approach during a historical time. First, as we had talked a little bit before, for many investors, staying invested will likely be the best approach. As we mentioned, looking at history, investors have fled to money market funds. Many consider them safe haven assets like CDs, but they do so precisely at the wrong moments, when markets were poised to rebound or grow over the long term. We even saw a lot of that going from Q1 to Q2 of this year. You can see the spikes during the dot-com bubble and the financial crisis, and again in recent months. Those who fled to those instruments this time around missed out on a historic second quarter where stocks rebounded sharply, and those investors may have simply locked in their losses by going to safe haven assets. In fact, history actually tells us that during a dip, which we saw in March, and may yet see again before this crisis is done, that rebalancing back to stocks in portfolios may help investors stay on track. A sell-off like the one we saw in March meant that a 60-40 portfolio, meaning 60% in stocks and 40% in bonds, looked more like a 51-49% portfolio due to the downturn. To meet long-term goals, investors may actually need to consider adding risk to their portfolios during drawdowns to get closer back just to their original asset allocations. This slide is one of my favorite that we deliver, and it's the ultimate reminder that diversification can win even when it doesn't feel good. You'll see different periods of time here where in the short term, you'd be unhappy as an investor. In 2000 to 2002, the diversified portfolio lost money. In 2003 to 2007, the portfolio made money, but didn't make as much money as the S&P 500. And while no one likes to lose money, the chart here reminds us why we build portfolios the way we do, why we build diversified portfolios. In down markets, you lose, but you lose less, and that can make a difference in the end. So as you can see here, over the long term, due to diversification, you can wind up returning more and earning more in your portfolios. Another overarching investment theme for the long term is that we prefer quality. Much has been made of the rally in mega caps, those large cap tech companies that have an outsized effect on the rally of recent months. But looked at in a different way, quality companies have good balance sheets, low leverage, strong cash flows, and may be more likely to stay steady during an economic slowdown. And when we saw that as markets dipped in March, these were the companies that were historically lower priced. Now, why is that the case? We see quality as the most resilient exposure against a range of outcomes in terms of developments in the pandemic and economy. So as volatility continues and investors consider rebalancing or adding risks strategically, quality might be a good place to start. So to wrap up here, I'd like to end with one last slide that will hopefully help you keep your sights on the long term and offer some optimism in this difficult time. It's been several months since the lockdown in the US began, and without a vaccine, it can be hard to imagine a world where we get back to our desired normal. But what I thought might be helpful is to show the historical performance of various asset classes after bear markets. Of course, historical performance does not guarantee future performance, and every financial crisis is unique. But we believe in the resilience of markets over time. And as you can see here from the data, across 9 bear markets that have taken place over 70 years, returns were favorable the 1 year after. 3 years later, returns still look favorable. And the length of bear markets, while they may feel elongated and harrowing during the time, they could be quite honestly be measured in a few hundred days. We shared this slide with many investors in April and May when the rally was still brewing and things were even more uncertain. And it's yet to be seen whether this rally can continue. But if anything, the last few months have shown us the resiliency of markets over time. So with that, just as a quick recap, as we spoke about in the beginning, we're closely monitoring developments of the 4 horsemen, the virus, geopolitical tensions, the election, and the policy response. We'll be monitoring developments as they occur, but until then, we hope, and I hope, that your family, yourself, your community stay safe, and you're able to look beyond the horizon to more hopeful times. So we hope this was a high impact presentation. Hope this was informative. I'm going to take this time to turn it back over to Dane and Tyler.
Thanks again, Mark. Appreciate that content. Very good presentation done. And thank you to everybody who joined us for today's call. As I mentioned before, if you have any questions about the content covered today, feel free to send us an email or call our office. We'll be happy to discuss those with you. If you enjoyed our webinar today and would like to share the content with friends and family, we will be putting a link to the recording on our website, howfinancialservices.com, and that link can be found on our videos page under resources. It may take a few days to get it posted, but just be on the lookout in the coming weeks. Additionally, we will be hosting more events like this periodically, so keep an eye out on your in your email inbox and our social media pages, and we just hope you have a good evening. Take care. Bye-bye.